Imagine trying to reach a destination without a map or a plan. It'd be like wandering through a maze blindfolded, right? That's how it feels without an investment strategy. Your goals might feel like distant dreams, and figuring out how to get there could leave you feeling lost. So buckle up, because in this video, we're about to dive into 10 popular investment styles. Welcome to the Finance Virtuoso channel, where we talk about all things finance. If you're seeking a daily dose of valuable information on money, business, investments, and savings, be sure to click the notification bell and hit the subscribe button now. Let's touch on key investing principles before anything else. First, avoid impulse investments driven by fear. Rushing rarely ends well. The best investments often don't grab everyone's attention. Second, stick to what you know. If a strategy feels unfamiliar, learn about it or skip it. This applies to stocks too. If you don't grasp a company's business model, it's wise to steer clear. Now, let's get started with the first investment style. Starting with number 1, buy and hold investment. The buy and hold strategy is like planting a seed and letting it grow over a long time. Here's how it works. You buy shares of a company and hold on to them for as long as you can. The success of this strategy depends on the performance of the companies you invest in. The neat thing is, it helps you avoid making hasty decisions, which can often lead to losses. You know how sometimes people panic and sell when prices drop? Well, this method helps you stick around, preventing those impulsive moves. To make buy and hold even better, try 2 things. First, choose companies with strong brands that are likely to stay successful for a long time. Second, don't juggle too many companies. Keep your list short. This way, even if some investments don't do well, it won't hurt your overall plan too much, and the ones that do great will become the stars of your portfolio. Number 2, growth investment. Growth investing is like riding the wave of fast-growing businesses. It's like betting on the companies that are on the fast track to success. When you invest in growth stocks, you're putting your money in companies that have the potential to grow quickly and give you good returns. It's pretty exciting because you're getting in on the action of innovative companies that are shaping the future. While growth investing can be thrilling, it also comes with some risks. Usually, the prices of these growth stocks are quite high, and they need to keep performing well to justify those prices. If they don't, the stock price can suddenly drop. So if you're into growth investing, do your homework and don't jump into investments just because everyone else is talking about them. Number 3, momentum investment. Momentum investing is a bit like growth investing, but with a twist. Instead of focusing on how much money a company is making, momentum investing looks at how its stock price is moving. Stocks that performed well recently are likely to keep doing well in the near future. With momentum investing, you buy stocks that have been doing great over the past period and hold on to them for a while. You might sell them all after a year and repeat the process. More advanced versions might rotate your money into the stock with the highest momentum every few months. Most of the time, momentum investing works out pretty well, but like any strategy, there's a chance of losing money too. It's often best to use a mix of strategies, including momentum, to keep things balanced. Number 4, value investment. Value investing is a strategy that has been a consistent winner for a long time. Imagine getting something for less than it's actually worth. That's the essence of value investing. You look for stocks that are trading at prices lower than their actual value or what they deserve. This kind of investing provides a safety net in case anything unexpected happens. The idea is to buy stocks at a bargain, so if the stock is undervalued, you don't need the company to make huge profits to get a decent return. To do this, you've got to dive into financial statements to figure out what a company is truly worth. Many cheap stocks are cheap for a reason, so value investors aim to find high-quality stocks at a good price. Number 5, small cap investment. Small cap stocks are the stocks of smaller companies. Smaller companies have more room to grow their earnings compared to big players. Doubling earnings for a $100 million company is easier than doubling for a $10 billion one. Plus, smaller companies often fly under the radar of most investors, so their stock prices might not fully reflect their potential. As more investors notice them, their stock price could rise, giving early investors a nice return. However, getting information about smaller companies can be trickier, and you'll need to put in more research time. Also, their stock prices can be very volatile. So while investing in smaller companies can be rewarding, it also requires careful risk management. Number 6. Dividend investing. Dividend investing is also known as income or yield investing. This strategy aims to give you a regular income through dividends. Dividends are like a portion of a company's profits that they share with their shareholders. Stocks with high dividend yields usually have stable earnings, although their growth might be slower. As a dividend investor, your job is to pick companies with high dividends that can keep paying them in the future. It's even better if the company can increase its dividends over time. Dividend investing isn't just about the income though. If you reinvest those dividends, your investment can grow even more. Dividend-paying companies also tend to be solid performers, making them a good choice during market downturns. Number 7. ESG investment. ESG stands for environmental, social, and governance factors. This approach evaluates how a company stands on these factors influences its long-term value. Responsible companies in these areas usually perform well over time. ESG investing includes SRI, socially responsible investing, impact investing, and ethical investing methods. These methods ensure that a company's resource usage aligns with positive values. ESG also considers how these factors impact investment returns. You can get into ESG investing by purchasing ESG-focused funds or using services that assess stocks based on these criteria. However, remember that ESG investing is still evolving, and its effectiveness is under study. So it's wise to do your research before getting started. Number 8. Factor investment. Factor investing involves making intelligent investment decisions based on evidence. Factors are characteristics of stocks that have historically shown strong performance over long periods. Some examples include value, growth, market value, and momentum. It's like breaking down stocks into measurable traits. Many companies have introduced ETFs, or exchange-traded funds, that track stocks using these factors. This makes it easier for advisors and even regular folks to build portfolios based on real data rather than just theories. Number 9. Passive investment. Passive investing is all about simplicity and long-term gains. Instead of picking individual stocks, you invest in whole market indexes. By investing in market cap-weighted indexes, you're automatically putting your money into the biggest and fastest growing companies in the market. ETFs are the popular choice for passive investing. These funds have low costs and can give you exposure to lots of stocks with just one purchase. Research shows that most actively managed mutual funds don't outperform their benchmark indexes. So, by choosing passive ETFs, you can track the market while saving on fees. Those fee savings can add up over time and boost your returns. Passive investing is like setting it and forgetting it. It helps you avoid making bad decisions during market ups and downs. Number 10. Core or satellite approach. Last but not least, let's talk about the core or satellite approach. It's like blending two different investing styles. In the core part, you hold ETFs, a basic set of diversified funds. Then in the satellite part, you add a few actively managed stocks. This gives you the best of both worlds. You get the stability of passive investing with the added benefit of actively managing a smaller portion for special opportunities. This approach lets you jump on unique chances that passive funds might miss. Passive funds usually make up around 70% of your portfolio, while active strategies make up the remaining 30%. You can use any of the methods we've discussed to manage the active part. When choosing your investment strategy, consider various factors. First, pick a strategy that intrigues you for better learning and investigation. Second, leverage your personal skills and knowledge. Financial statements for value investors, for example. Time is important too. Value, growth, and small cap strategies need more research, while momentum and passive methods are quicker. Lastly, assess your risk tolerance based on your finances and personality. If volatility concerns you, opt for passive investing or diversified portfolios. As an investor, combine approaches to craft a unique strategy that fits your size and preferences. Remember, the key is to find the style that fits you and your financial goals best. So, now that we've covered these investing styles, which one sounds like it might suit you? Feel free to share your thoughts in the comments below. And if you found this video helpful, don't forget to hit that like button and share it with your financially virtuous friends too. Thank you for watching.